know that massive Trans Mountain pipeline expansion is going to kick in pretty soon, we hope, as taxpayers, after spending tens of billions of dollars on the thing. That is likely to provide a new outlet. It will provide a new outlet for Canadian heavy crude, and it's likely to narrow the discount, perhaps dramatically, in the short term. However, the oil sands companies have been steadily boosting production. And could we start running short on pipeline capacity before too long? We're joined by Rob Lauzon. He's Managing Director and Chief Investment Officer at Middlefield. Great to see you, Rob.
Yeah, nice to be back.
So finally, we'll get Trans Mountain.
Sounds like May.
Okay, is that the latest?
That's the latest.
Yeah.
A couple hours ago, but things are always moving. But call it Q2.
Q2, okay.
May or June.
And it seems like a given that it will be an outlet for Canadian oil, long awaited.
Yeah, over to the refineries for jet fuel over in Asia, on the west coast of Canada. But what that does is, if you think you've got a sink full of water right now and the storage is full, nowhere to go, you got the drain now can go to Asia, and then your level goes down of your sink, and now anything that was going to the United States can refill it back up. So you kind of have two outlets: the pressure, the boil. You can cut the boil, and you have pressure off. So oil flows to the U.S. Quicker at better prices because of the outlet going to Asia, which is the TMX expansion project that our government owns, and we'll see who they sell it to. I think the plan is they want to sell it eventually and get it off our books, taxpayers' books.
Will there be, I know we're straying into politics here, but would there be heat for the government, whoever they are at that time, if there's a big taxpayer loss, if we take a bath on it?
Who knows? Who knows? I think anyone that already knows the cost overruns knows there's going to be a loss. But if you think about it, it's a cost that is incurred for the benefit of the country. So if you're thinking Canadian oil sands have reserve lives on the books of 30, 40 years, but actually have 100 years of oil in the ground, if we can get a better price, which means better royalties for the government for 100 years, the pipeline will pay off, no problem, because that's the amount of oil we've got in Canada, and we need to champion it and use the tax money that we earn on the royalties of producing our own oil to build roads, bridges, schools, do a lot of things, make Canada better.
Is it likely the Alberta production will keep ramping up and will start running tight on pipelines again, do you think?
I think there's enough oil in the ground, and as long as price, which is really dictated by OPEC and the Saudis, they still control the market. As long as price allows it, you will always have our pipelines full, because the producers will plan. They already know with TMX coming on, there's an extra 600,000 barrels a day coming on. The main line of Enbridge will be full. And then there's no other outlets. No one's building new pipelines. So they will plan, and in 2-3 years, all the pipes will be full again, but they won't overspend and overbuild on the production. So I'm not worried. I just think they'll be full. And our crude will always trade at a bit of a discount, because we are at the end of, we don't have a boatload of refineries being built in Canada where there's 14 new ones that we're refining product here. But we're going to get better prices than we have in the past, which is good for our producers. But again, it should be good for the TMX pipeline, whoever owns it in the future. Enbridge pipes should still be full, because the world is still using more oil. We're at 102 million barrels a day used. It's going to 103, it's going to 104. We're still flying in airplanes. No one's sticking a battery in an airplane and flying electric airplanes around anytime soon. So we've got a lot of demand from the developed markets, Asia, China. I think Canada's in a very good spot here.
What's your outlook for oil? Do you think WTI gets above $80 anytime soon, Rob?
There'll be little spikes, and probably, you can easily get a range of 65 to 90 based on the economy. Okay, but I think 80 is where the Saudis want it. 80, 85 Brent, that's kind of where we are. I think they're happy with it there. The Saudis don't want $120 oil, because then you get demand destructions and we change our habits. Then we will all buy Teslas.
That's interesting.
But if it's 70, 80, we're happy driving our SUVs still and flying airplanes. And so I think that's now geopolitical shocks We saw it with the beginning of the Ukraine and the worry on natural gas and oil. We had spikes to $100.
And look at the spike there in early 2022.
So, but what happened is the Saudis are only producing just over 10 million barrels a day. They have capacity to produce 12 million right now, but they're not. So I think the hedge funds and the financial players know, I'm not going to buy a bunch of futures contract and jam oil up to $100 right now, because at that price, the Saudis will want to bring on production, bring on supply.
Grab the cash.
And bring it back down to 80, 85. So we're actually in Goldilocks right now. 80, 85 Brent, 75 to 80 WTI, differentials narrowing in Canada, so we get a little bit more for our oil. And if you look at the companies we invest in, they're paying down their debt. So the balance sheets are cleaner in the energy sector than most sectors out there. They're raising their dividend, they're buying back stocks, they're being pragmatic. It's a really good ballast to your portfolio to complement your innovation and your technology, which is doing well. You need diversification, and don't put all your eggs in one basket, but definitely make sure you have some energy in your portfolio, because the valuation is very cheap right now.